Hello, all. Welcome to ETF Edge, your go-to place for everything ETFs. I'm your host, Bob Pisani. We're going to be discussing some of the top ETF movers and shakers in the last few months and the prospects for the second half of the year. Our guests, as always, we've got the best in the business. Dave Nadig, of course, you know, Chief Investment Officer over at ETF Trends. Phil Mackintosh is Nasdaq's Chief Economist and all-around ETF expert as well. Phil, let me start with you. You sent us a list of some of the top 25 ETF movers, not just by price action recently, but also by flows, which is also an interesting way to look at things. It's a strange group. So it includes airlines like jets, which is attracting ridiculous amounts of attention given the size of it. The financial services ETF like IYG, small cap ETFs getting a lot of action, SPSM. You mentioned, and even ESG ETFs like ESGE also are moving. Tie this into a bow for us and make some sense of us. Airlines, banks, small caps, ESG. What are investors doing right now?
Yeah, I mean, I think we've been watching this top 25 list since the coronavirus sell-off started, and you've really seen a cycling of investor appetite. Obviously, back in March, when everything was a rush for cash, there's a lot of trading by the experts that use ETFs, and it's sophisticated retail as well as sophisticated hedge funds looking at the bond ETF. And then we sort of moved as we realized that the energy complex was going to be suffering from a lack of demand into the energy complex selling off. But as we've started to get back to work and we've started to look at this recovery trade, you've definitely started to see some different ETFs trading. So around about a month ago, we were looking at construction ETFs. Financials started to pick up just because financial ETFs had sold off, and some of the provisioning that had came through earnings in Q1 was really pretty significant. And people were worried that the original coronavirus shutdowns would lead to credit crises. Now that we're getting back to work, that's started to alleviate. But what we're seeing, I think, in the last week or so is actually some reversal trades of multi-year trends. So if you look at the performance of value over growth, growth has beaten value year after year after year, pretty much since we came out of the credit crisis. If you look at US markets versus international, the same sort of thing over an even longer time frame. And then again, with large cap, like large and mega cap stocks have really led this rally. And so what I think we're seeing in some of the trends this week is some of the people putting on bets that those trends that actually stretched during the coronavirus sell-off might come back. So we've seen value, and we've seen small cap, and we've seen a lot of trading into international markets because they've been stretched on the downside, probably oversold. And as we see people getting back to work, as we see Europe's getting back to work and not seeing a case spike, it makes sense to start to think about whether those economies might recover a little bit more quickly than the US market.
Yeah, a lot to chew on there. Dave, Phil was mentioning retail. I'm loving all this attention that Jets is getting. This is the Airline ETS, which, as you know, is ridiculously small and whose assets under management has exploded in the last 6 weeks, largely around a publicity associated with Robinhood, that the millennials seem to be trying to pick bottoms in certain things like airline ETFs. Explain the zeitgeist here. What's going on? Wrap up Robinhood and millennials and ETFs for us.
Well, you know, this website called Robin Track came out, which lets us actually track the number of holdings, not the dollar value, but how many accounts hold different stocks. And we've seen things with USO when people were trying to call the bottom in oil. We saw that with jets when people were trying to call the bottom in airlines. Now, I think it's a mistake to think that the $1 billion that has flowed into this fund is all mom and pop investors. That's not what we see in the 13F filings. It's not what we see on the tape. It's clear there's some very sophisticated folks out there, most likely hedge funds, using this. It's a well-constructed fund if you're trying to play the airline industry. There's nothing to fault with it. So it's not surprising that we're seeing a lot of bottom fishing here. We're seeing it in every sector that got heavily beaten up in the worst of it in March, whether that was in the energy, some of the financial services stocks, and all the trends that we just talked about really play into that. You know, small caps, we just had the Russell cross that's 200-day moving average to the upside. You know, when we talk about financials, we're seeing a bunch of those stocks come back. Value, all of these are, as Phil pointed out, these kinds of reversal plays. And sure, there's definitely some retail participation there, but I think it would be a mistake to think that this is just, you know, pajama pants traders.
Well, you're right, Dave. Of course, we point out that it's very likely that professional investors are using this to even as a shorting instrument
Sure.
for the airline industry. I think part of the problem is we can't really get our hands around retail participation. It's very difficult. We use partial data, not anecdotal, but partial data like the Robinhood data, which makes it available. We can get Ameritrade sometimes to comment on flows in their ETFs, but we don't really have good data about who is exactly buying what. It's all a little bit piecemeal. Phil, have you had any success parsing this out? We're always interested in what the, as Dave was saying, the professionals coming in who are either going long or shorting something like the airline ETFs versus, everyday investors and what they're actually doing. Have you any success pulling apart that thread?
Yeah, I mean, there's a couple of different ways to attack that. I mean, obviously, in the Q1 earnings, the retail brokers talked about the record number of new accounts that they've seen opened during the coronavirus, and they've seen a sort of increase in new accounts since they went to zero commissions as well about 6 months ago. But there's other data you can look at that's by ticker. It's a couple of weeks or to 4 weeks delayed, but what you tend to see actually is retail like to trade less liquid stocks. It's the hedge funds that tend to trade the super liquid ETFs. So all of those sector spiders and SPY and IWM and EEM that you hear about all the time are often really actively traded by market makers and hedge funds that are sophisticated. They may be long, they may be short, but they're pretty actively traded. But these days, there's such a huge complex of smart beta ETFs with really interesting thematic exposures, and you tend to see retail going in and out of those more.